Hi, Peter Rose, Longwood Currency Trading. I'd like to talk to you a little bit this morning. It's a beautiful morning in New England, by the way. It is the 14th or 15th of June. Yeah, we're getting almost into summer here. It's very pretty. But the topic I wanted to cover today is why beginning traders fail, or why I feel that they fail. And I think maybe the biggest reason is that they trade short stacked. You can't come into the market with $100 and trade it all. You're just not going to learn anything. There's so many of these videos on YouTube where the guy is saying, you know, start with $100, start with $300, and you know, we're going to trade. It's just not feasible. If you don't have more than $100 or $200 at risk, then it's just not going to hurt. I don't care how poor you are. If you've got the grapes to go in and trade currencies, then that $200 can't be life-changing money for you. So you're just not paying attention to that. What you're doing is you're trying to take what this guy is saying. You take your $300 and run that to 10,000. Now maybe under, you know, the trading gods smile on you. Yeah, maybe you're going to be able to do that. Probably not. 99.99999% chance that you're not going to take $300 and run it to 10,000. There are some people that can take small amounts of money and run them up because they're playing with really high leverage. But that also means that you get wiped out really quick also. So that's not viable. That's not a viable solution. And it's not fair to think that you're going to take $300 and run it to 10,000 or more money. It's just not, it's stupid. Okay, so if you listen to that shit, you deserve what you get. My feeling is that if you're going to trade, you come to the table with $1,000. U.S. Currency law states that in order to trade currencies, you need to have 5% down. So if your currency pair is at a price where it's an even $100,000 for a full lot of currency, then 5% of that, you need $5,000. So if you're going to trade a mini lot, you need $500 up front just to start. So the $1,000 gives you the $500 a margin and $500 to play. At $1 a point, that's 500 points that you got to lose before you run out of wood. So that's pretty good. You can do that. Because if you have $1,000 up, it means that money, or that loss of that money, that's going to impact on you. Even if you have a lot of money, $1,000 is a lot of money. You can't play with so little money that it doesn't matter. You know, unfortunately, this is a problem that I have, and I'm an experienced investor. I mean, I've done real estate for 40 years, and I've been studying the currency markets for a while. And yeah, I got wiped out like everybody else. But I know some reasons of why that happened. I listened to some of these videos and didn't really look objectively at what needed to be done. But for me, because I incorrectly started trading with a large account and got used to that level of thought process, you know, lose $500, make $1,000, you know, that sort of thing. It became relatively small change for me when I had to go back and start trading with a $1,000 account, start over again. Actually, I didn't. I did the $5,000 account after I'd lost $50,000. I had 5 left. I doubled that in 4 or 5 months once I figured out what was going on, and went through and suffered a few more losses. I've got the action down, but what I realized recently was, because I am used to big numbers, and real estate is big numbers, opening a currency account with $40,000 and $50,000, that's big numbers. For me to lose $10 or $20 or $30 on a trade is insignificant, even though that might represent 3% of my $1,000. And in fact, I just did a video on losing, took a 57% hit on a little bit larger bank because I just let the thing run, and it just didn't mean anything to me. Losing $500, $1,000, I was wrong. I made a mistake, and I just said, to hell with it. That was the problem. So if you're new to currency trading, you don't start out with a big account. Don't do it like I did. But you can't come to the table short stacked either. I think that $1,000 is a good starting point, and I think that even if you're a millionaire, don't come to the table for a real account with more than $1,000. Don't even put more than $1,000 in your account, because the whole point of the thing is that you have to learn how to trade for pips and not for dollars. So if you're trading $1,000 account, each pip is worth $1. So if you have a 10 pip stop or something like that, that's a 1% of that account, or 20 pip stop is a 2% of the account, and that's reasonable guidelines. I mean, you've got $500 of runway there on that 1,000 above your margin, so it gives you the ability to make a lot of mistakes for very little money. But if you think of it in terms of the money, $20 a day loss or $30 a day loss, again, it's not that much. But you start thinking in terms of pips. Gee, I just lost 30 pips, and that's a 3% hit on my bank. That's not real good. But you can't think of it as $30, because the $30 doesn't mean anything. That's a pizza, for Christ's sake. Come on. But the danger is then, even if you develop skill with that $1,000 and then you go into the live account, it's really hard not to think in terms of dollars. But look, boys and girls, you're just not going to take $1,000 and run it to 10,000. Any more so that you're going to take $1,000 and build a real estate empire. It isn't going to happen. It isn't going to happen. So if you want to play for money, then you've got to put a lot of money up. And if you're not used to trading for pips, but instead trading for dollars, and you put a lot of money up, and that first loss that you take is $500, and you're used to trading so that it would cost you $5, your roids are going to get flared up. That just isn't that isn't going to work. You just can't do that, because when you start trading the larger amounts of money to make significant money, I mean, if you don't have $50,000, $60,000, $70,000 in your account, you're not going to make any money that's of consequence. It's going to change anybody's life. If you could make 20 or 30% a year on your money, that should be really reasonable. 20 or 30% on your risk, non-compounding. I think that's probably reasonable to do if you're careful. But what are you going to do? You're going to take $1,000 or a $2,000 bank and run that 30% a year? I mean, what is that? That's $300, $600 if you're trading a $2,000 account. What is that? $500? What is that? Well, I mean, if you don't have a lot of money, then that might be your cable bill or your beer bill or something. I don't know. But you're not going to take a $500 account and run that to any amount of money that's significantly going to change your lifestyle. And so the number one rule, I think, beginning traders, the reason they fail, I think it's because they play short stacked, and they're trying to run that short stack to a lot of money. You can't do that. The second rule is not taking immediate loss. And the third rule is closing trades based on profit instead of on risk. Now, I did a video on both of those, or each one of those before, but I wanted to include them into this video because it's specifically reasons why that beginning trader is going to fail. First of all, they're going to come short stack to the game, and they're going to try to run that to big money. That's a kiss of death. The second reason is they don't take an immediate loss. And that's a psychological thing. It has nothing to do with the techniques that you're taught or anything else. It's when the trade goes against you, get out, get out. Don't sit there. This is a problem with me. I don't get out because I just think, I don't know, it's Monday and the Federal Reserve won't change the interest rates or whatever, and everything is going to be okay. It's not going to snow today. It's stupid. It's stupid, and I just because I've backed down on these little accounts at this point until I refund my big account. It's just not significant enough, so I don't take that immediate loss when I should. When I do really well. My monthly gains over long stretches of time are really good. But I think that's probably the second problem with beginning traders is you don't discipline yourself to take the immediate loss. And I think a lot of that is because you're thinking of it in terms of dollars instead of in terms of pips. You're trading short stacked, and so you see that you're $20 down or you're $30 down on that little account, and you just go, oh man, I just can't close it out with a $30 loss. I just got to let it go. If it was a 30 pip loss, you'd probably get out. You'd probably get out at 5 pips or 10 pips, because it's just pips. That's why professional gamblers don't trade with cash. Play poker with cash. They play with chips. So they're not trading cars and jet skis and all that stuff. They're trading chips. It removes the emotion from it. And you need to remove the emotion, if you're a beginning trader, from your trading. Take the immediate loss. Take it in pips. Don't take it in dollars. It's the same thing, but you'll think of it differently. And the third thing is a video I just did the other day on closing trades based on profit as opposed to risk. When your trade is in profit, the beginning trader says, oh, it never hurts to ring the cash register and pull some cash off the table. Well, yeah, that's great. How are you going to run that account up if you keep pulling cash off the table? Plus, when you pull the cash off the table, now you reduce your reward to risk ratio. It's crazy. When you're trading a large account, then you can pull cash off the table based on a profit. But when you're not working with a lot of money, in order to develop discipline, when you are trading and your position is in profit, you can't think about the profit target. You have to think about, what's my trade doing right now? What's price action doing right now? Is it starting to fail? Is it starting to slow down? If it is, get out. Get the profit and capture it. If it turns around and keeps going in the direction that you were going to go in, well, you could get back in. But if you don't close it out when price starts to stall, then you start losing profit. And then you're in the same game that you were before. Oh, I've lost, $50 or I've lost $100 so far on the trade. I was up 300 and now I'm only up 200. I've lost, but I'll make that 100 back. You can't do that. You got to catch that right away. You got to catch it and trade based on the risk, not the profit. Who cares what your profit is? The profit will take care of itself, but not the risk. You can take care of the risk. That's the only thing you have control of. So look, if you're a beginning trader, or even if you're not, even if you're an experienced trader, we're all prone to this stuff because most of it's psychological, right? Number one, don't trade short stacked. Number two, take an immediate loss. When it goes against you, get out. And number three, close your trades based on risk. Forget about the profit target. My name's Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.